Hello, clients and friends. This is David Ware from Ware Financial, and it's my pleasure to present our first quarter economic review for 2026 because we believe an informed client is our best client. So as you watch this, please keep in mind it's a review of the months from January through March of 2026. As 2026 began, equities carried forward the momentum and investor optimism that defined much of 2025. Markets entered the year on solid footing, supported by expectations of interest rate cuts, continued earnings growth, and improving market trends. However, that favorable backdrop began to shift as the quarter progressed, primarily due to geopolitical tensions in the Middle East and involving expectations around the Federal Reserve's policy path due to inflation. So these factors fueled concern and volatility. But by the close of the quarter, the market rallied and regained some losses, with the S&P closing at 6,539. However, with that rally, the S&P still ended down 4% for the quarter. The Dow closed at 46,254, and again, despite one of the strongest single-day rallies in March, it was also still down 4% for the quarter. For January and February, inflation continued to show some incremental signs of easing. The February Bureau of Labor Statistics data for the year-over-year core consumer price index, it rose as expected at 2.4%. During the quarter, the U.S. economy remained remarkably resilient. Labor markets continued to show strength and consumer spending remained healthy. This played into the Fed's decision to hold rates steady. After the quarter closed on April 10th, the March CPI numbers were released as expected. The headline CPI rose to 3.3% year over year. This was because mainly because the impact of the Middle East, the war that's going on in the Middle East, with surging energy prices, when it began to surface. The Federal Reserve is still looking for an inflation rate of 2% or less, and with energy prices rising, this may not be accomplished for some time. Inflation numbers are a subject we need to carefully watch for the next quarter. The federal funds interest rate during the first quarter remained stagnant. At their March Federal Open Market Committee, the Fed adjusted some previous views on the economy, notably a slightly faster pace of growth and higher inflation. Projections for the remainder of 2026, but so far they are keeping their rate steady at a range of 3.5 to 3.75%. As financial professionals, we always monitor interest rates. U.S. Treasury rates also experienced some volatility in quarter one and generally rose. This was particularly driven by persistent inflation concerns, continued economic growth, and geopolitical tensions that we are experiencing. As the quarter ended, the 10-year Treasury yield was 4.35%, the 5-year Treasury yield was 3.97%, and the 30-year Treasury yield was 4.91%. Bond behavior continues to hinge on the direction of interest rates. Should the Fed pursue additional rate cuts, existing bonds could appreciate in value. Conversely, expectations of slower easing or persistent inflation pressures could push yields higher. For investors, bonds continue to play a meaningful role in portfolio diversification. While recent volatility highlights that bonds are not risk-free, especially in a rising yield environment, they can still provide relative stability compared to equities during periods of market stress. However, please remember that while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against a loss. The elephant in the room is the price of oil. Due to the conflict in the Middle East, oil prices have risen significantly, and everyone is feeling the squeeze, from personal transportation to the price of moving foods and goods. The consumer price index could continue on an upward turn should oil prices remain elevated. The quarter ended with possible optimism and easing geopolitical tensions, and long-term analysts think that eventually energy prices will correct themselves. The situation in the Middle East will take some time to sort its way out, and we will be keeping a close eye on how things unfold. Safety still comes at a cost, and sadly, many major banks are still only offering low interest rates to savers. According to Barron's, the average bank money market rate on March 30th was 0.51%, and the average 12-month CD rate only 1.85%. So anyone who is interested in exploring sources of better interest rates, please contact our office. We'd be happy to see what's available. As the quarter closed, volatility remained prevalent and is likely to be here for a while. While we are still technically in a long-standing bull market that has had several pullbacks, if things get rough, the news and media could use a lot of terms, and we want to remind you of some of the most common terms used when it comes to volatility. So a dip is a short-lived downturn of usually less than 5% from a sustained longer-term uptrend. A correction, like we experienced in April of 2025, is usually a 10% drop in the market from recent highs. A bear market is a long sustained decline in the stock market of 20% from its recent high. While not enjoyable, these movements are a regular part of the investment experience. While investors are still optimistic, market volatility is likely to persist. This makes discipline and perspective essential. As you can see from this chart of almost 40 years, and in many crises, the market does not move in a straight line. In the past 38 years, investors have experienced multiple downturns in equities created by external forces. But one thing that has been constant over this period is that those who invested well and continued a long-term perspective saw greater results. Even the most recent downturn in April of 2025, when markets reacted to uncertainty around tariffs, we experienced a correction, but by the end of 2025, equity investors who demonstrated patience and discipline were rewarded. In summary, uncertainty and volatility remain and are likely to be here for a while. However, equities continue to be resilient. The market resilience has been fueled in part by continued growth in artificial intelligence, a resilient labor market, consistently strong corporate earnings, and the Federal Reserve's anticipation that eventually we could see future rate cuts. The Federal Reserve kept interest rates unchanged. They remained at 3.5% to 3.75%. The Fed noted that while they remained stagnant in the first quarter, we could see rate cuts this year. Inflation increased, but at expected rates. Traditionally viewed as a safe haven, bonds experienced some volatility of their own during the first quarter. We will continue to monitor key items that could continue to fuel volatility, including oil prices, the path of inflation and interest rates, and geopolitical uncertainty. Focusing on your long-term goals and staying the course with a well-guided plan can help you stay grounded and confident during these times of uncertainty. We are here for you, so please, I want you to reach out with any questions or concerns, because your financial well-being is always our priority. And once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Thank you for watching this update. Please feel comfortable sharing it with anyone else that you can think to benefit from it. And again, if anybody has questions or concerns, please call the office so we can talk through it. Thanks and have a great day.